Hey guys, a rough overview, right? The Coles notes, just something simple so that anybody listening that might not get all the technical information could still really get a good understanding about what these charts are. Okay, so let's take a look here. Let's go down. So this first one here, okay, U.S. labor force participation rate and the U.S. government debt as a percentage of GDP. Okay, inverted. Okay, so flipped upside down. Okay, so that's the red one, is the US government debt as a percentage of GDP, flipped, inverted, upside down. Okay, so this isn't directly a crypto chart, it's more of a macro, what's going on specifically in the US on a on the in the grand scheme of things, like which direction is the entire economy heading and what's going to be done about it. Okay. So the black line here is the US labor force participation rate. So you can see that it's going down. Okay. So the amount of people that are working is decreasing. Okay. So how it works is the fewer people that you have working, the fewer people you have contributing to the GDP. Okay. So as people, there are more people retiring than there are people joining the workforce. As birth rates go down, you have less people producing, fewer producers in the economy. Okay. Now, as a result of that, the government debt as a percentage per GDP is going up, right? It's going up. Now, this is inverted. It shows it going down, so you can see the correlation. Okay. So, amount of participants in the US going down, debt to US government debt as a percentage of GDP is actually going up. Okay, you invert it, you can see how they correlate. All right, so what's the response to this? If there aren't enough people that are contributing, that are paying taxes, there aren't enough people to inject enough liquidity into the government to pay for its debts, then the only answer is you got to come up with the money somewhere. The way that they come up with the money to pay those debts, cha-ching, print the money. Okay? Until there's a way to add producers to the economy, and that can happen through a baby boom, which doesn't look like it's going to be happening, and it would take 18 years for that baby boom to reach the market to be able to start working. The other thing is there could be a boom in robotics and AI to fill that gap of producers, but that's not going to happen tomorrow. So from now until then, which is this looks like the way that the world is going, to fill the gap of producers, there's going to be a huge increase in the amount of robotics and AI to fill those working gaps. But it's not going to happen tomorrow. So from now until then, it's going to be print. Printer, turn it on. Okay, so that's what this is showing. This one over here. So net liquidity equals a Fed balance sheet minus Treasury general account minus reserve repo. Okay. So here you have the Fed net liquidity. Okay, the amount of money that the Fed has. Okay, and it breaks it down over here if you want to get a little bit more into the weeds. And then again, the US government debt as a percentage of GDP. Okay, now this time it's not inverted, it's left as it is going up. Okay, so here you can see very clearly that as the US debt rises, this red line, the Fed net liquidity has to raise also to be able to pay debts. Okay, so as the debt goes up, liquidity has to go up. That's what this is showing. Okay, and debt is going up. Liquidity will go up to match it. Okay, now looking over here, so here we have total liquidity. Okay, it breaks down exactly what the difference between total liquidity and just net liquidity is. Okay, and then we have federal government current expenditures, interest payments at a 30-month lead. Okay, so all these charts here that I'm showing you that are the same color here, I just want to say that these are from the GMI Global Macro Investor, which is Raoul Pal, macroeconomist, hedge fund manager turned crypto dude. Okay, so he's a guy to watch. He gets into the weeds, pretty technical. So we're going to do our best to kind of pick and choose his best charts that we really like, and try to break it down in a way that maybe somebody that's not neck deep into this stuff every single day will be able to understand. That's the goal. All right, so we can see here on this chart that the black line, right, total liquidity, US total liquidity, is following the red line, again, federal government current expenditures. Okay, the interest payments. Okay, we can see the direction that this is going, and we can see liquidity is going to be following it. It has to. Okay, it has to keep up with these payments. Again, we don't have the producers to produce the amount of money that we need to pay off these debts. We don't have the AI and the robotics to subsidize what's missing as far as producers, humans. Only answer is to print. Okay, it's coming. Over here, now we're getting into liquidity cycle, we're getting into crypto, um, we're getting into high risk assets. Okay, so here again, GMI, Global Macro Investor, they have this chart breaking down the liquidity cycle. This is not the Bitcoin cycle, okay, based on the Bitcoin halving. This is based on liquidity. And it's broken down into 4 seasons. Okay, now just to be clear, these aren't the actual 4 seasons based on a calendar year. Okay, they don't line up to be spring is in spring, summer is in summer, fall is in fall, and winter is in winter. Okay, that's just the 4 terms they used for liquidity cycle seasons. Okay, don't match up. So the we can see that in the past, summer and fall are the biggest uptrends. Okay, summer and fall. Boom, summer and fall. Boom. Winter, typically the bear market. Spring is kind of the maybe Bitcoin season, you could say, kind of sideways for and not so great for alts. Summer, more of the same. I would say more Bitcoin season. And then finally in fall, you get time to get into alts. We're going to get, this is typically when the liquidity is added to the markets. Okay, liquidity is added here. Okay, global liquidity is added. And in 2017, global liquidity was added, not so much liquidity coming in through the United States, but that's when you had your big uptrend. Here it came earlier because of COVID, right? COVID happened. The Fed had to jump in, put in trillions of dollars of liquidity. I think it was an equivalent of about 40% more dollars added than existed before, which is insane. Okay, so you had this big run up here in Bitcoin, and then fall, This was when alt season happened. Okay. Here, we've had a pretty sideways summer as the Fed and many other countries have been late to add liquidity, later than before, mainly because they've had to hold out for so much longer because they added so much liquidity here. They've overcorrected here. Now it's taking them a long time to kind of come back from that because inflation went out of control here. So much more than in past cycles because we had this massive black swan. And they overprinted that it's taking them a long time to bring inflation back down to normal levels before they can print again. And they're going to have to print again soon because they're running out of time and their balance sheet is running low. So it's going to happen soon. So sometime between now and the end of the year, we're going to see a big print, and we're going to see this leg up. Okay, and I think it's going to be a big leg up because we didn't get to see very much of a leg up in liquidity in crypto summer like we have in the past. Okay, so we got some catch up to do. Okay, and because it's been so delayed, because the Fed has been delaying it, we could see it go into Q1 of 2026, which we've seen liquidity go up before into crypto, into liquidity winter, right? But the difference is, and I can show you, maybe I'll do a different video, that liquidity continues to go up, okay, into crypto winter, into liquidity cycle winter, after Bitcoin and crypto have peaked and rolled over. So that's something that we're going to make a video about how we have to be careful about following the M2 global chart too long into the cycle because it continues to print quite a while after, several months after BTC and crypto have found their tops. Okay, so that's something that we're going to have to, we'll do a video on that another time, about using a basket of indicators for identifying the crypto top because it doesn't line up with liquidity and global M2. Okay, we'll go over that another time. All right, so here we have the DXY. Okay, the strength of the US dollar. This is interesting because it's basically correlated but inverted. Okay, I didn't invert BTC here so that I don't know why I didn't. Maybe I should have, but I didn't. Okay, so it's basically works the opposite way of Bitcoin. Okay, so you can see here, the US dollar bottomed on our trend line. BTC had a top. Okay, then we had the dollar go up to this blue line here that I have, green, blue, whatever color that is. And that was when BTC bottomed. Dollar came back down. Okay, BTC topped. This was at the top. We were just getting ready to go. Okay, so this is one that personally I find it very interesting. It kind of tells you ranges and it gives you like large scale idea of where we are. It's not something that you use to trade off of, okay, because it's not exactly perfect, but it does work really well for Confluence to tell you like where we are in the market, like what stage we are in the market, right? If we're down here, we're in getting closer to the top. It can hang out down there for a little while. If we're up around the top, we're in around the bottom of Bitcoin and crypto. Okay, now we're heading down, perhaps sometime in Q1 of 2026. We'll be down here and we'll find another top of the crypto market. Okay, that's kind of what I'm watching. And then down here, if you're watching the RSI, you can see that as this topped up, we're in the bottom range. Okay, so it's pretty cool. It lines up really well. So now we're watching to see when we get back down into the 36 level, should give us an idea of like, again, one of those to add to the basket. When we get down into this 32nd into the 36 level here on the RSI, it's time to look at the rest of our indicators that are in the basket of telling us when BTC has peaked. Okay, so this is an interesting one. Keep an eye on. This is one that you guys know. This is one that I really like. Global M2 money supply, 12-week lead seems to be working really well. Now it's not going to be to the day. It's not going. Sometimes it's going to be a 10-week lead. Sometimes it might be a 15-week lead. But what we're doing here is we're watching the trends and looking for bottom ranges to enter and exit. Okay. I mentioned earlier in this video that I'm going to do, maybe me or Minnow, I'm not sure. We haven't discussed it. But a video about when this indicator works best and when you do not want to follow this indicator. Okay, because it's not 100% through the entire cycle, through the entire liquidity cycle. I mentioned it a little bit earlier in this video when we're going through the 4 seasons, but I'll do a specific video about this and why. Okay, so as of right now, this is one that I'm watching closely because of where we're at in these 4 seasons of the liquidity cycle. All right, so we are here. It's still pointed up. We're still moving up. They're still adding liquidity. What I'm watching for this is I'm watching to see if sometime in the midsummer, as of right now, you can see that this goes, this goes to the end of July or mid-July. Yeah, mid to the end of July. I'm watching to see if this rolls over or if this thing stalls out and goes sideways for 2 months. If that happens, like it did here, when this thing stalled out and went sideways, Bitcoin went down and to the right over a period of months. Altcoins, what I'm in, they went down hard. Okay, so if we see this thing stall out and go sideways, altcoins are going to go down hard. They're going to bleed back into Bitcoin, bleed back into stables. If it rolls over, same thing. Bitcoin goes down, altcoins go down harder. So I'm watching this. We have a 12-week lead on it right now. We're here. If we see this thing roll over, by the time we get up here, we'll see what's happening in 12 weeks in advance, and we'll be able to take some heavy profits. Okay, watch and try to time the bottom once again to get back in with all the extra stables that we made by taking profits here to get back in at another solid level. I think that's best case scenario. The other case is this thing just keeps on going, some sideways action all the way up until the end of the year, Q1 2026. That's another option. Okay, that's what I'm thinking anyways. All right. Here, this is interesting. Also, this is for the Bank of China balance sheet. Okay, so what we have here is the Bank of China balance sheet. Okay, that's here in the red line in US dollars, and then over here we have the 10-year bond yield. Okay, shifted for 22 months. Now, It doesn't track exactly perfectly, right? You see that there's more. Uh, I guess the ups are higher and the lows are lower here on the yield, but you can see that they're following the same trajectory, which is what we're looking at. So basically, this means same as the U.S. Um, the chart as the yield is inverted and it goes up, the debt has to raise to follow it. Okay, so that's what we've been watching, and that's what's going on. This one over here, it's showing Bitcoin dominance. Okay, this chart, Bitcoin dominance excluding stables. Okay, now this is interesting because it shows that we're getting much closer to topping out when you exclude the stables than when you include the stables, right? Because the stables they they take away from the volatility, okay? And there have been many more stables added to the market than there were back over here, okay? So it really robs the volatility adding all those stables to this chart. Okay, so I haven't done, this is from maybe 10 days ago. I think it's gone up since. So we're probably getting closer to this top range here. And this is actually from today. Okay, this shows the historic risk levels of Bitcoin dominance. And you can see that today we are in the darkest of cherry reds that we haven't seen since the very peaks of Bitcoin dominance. So we're in between the 0.9 and the 1 right now. We're at 0.928. So we're highest risk that we've seen since back here. Okay, the first peak in April. Okay, I think that's, yeah, something like that. Anyways, back in this area before we saw a really good alt season here and here and here. All right, so this is looking red hot, getting really close. Okay, so here again, this is basically similar to what the chart we were looking at in China. This, except for this one here, is a bit different. It shows the red is where we have an inverted yield curve. The black is when we don't. Okay, so when we have an inverted yield curve, when the shorter term yield bonds are paying a higher interest rate than the longer term yield bonds, it's inverted. Okay, typically the longer you invest in something, the more interest you get because you're taking on greater risk for a longer period of time. Well, this is not the case. This is inverted, where the shorter term is paying a higher interest rate than the longer term. Okay, so when this happens, it often prompts the Fed to lower interest rates short term. Okay, trying to stimulate growth in the economy, as it says right here. Okay, so Feds were cutting interest rates here and raising interest rates here. Now we're starting to see some more red. We should expect to see more cuts soon. Okay, so that one is that. Here's one that we're all very familiar with, Bitcoin USD. This is the weekly chart. Now we can see a lot of really bullish signs here. All right. We have the relative strength index. We can see that as we're in a bull market, we've basically never gone below the 44 mark before we had a rebound. Okay, we went below it here. This was finding the bottom in the bear market. Okay, so we've hit that twice before during this bull market, which ended up causing massive rallies. We are back there once again, looking forward to the next rally. Okay, maybe probably bringing us back up to the 78 level. We'll see when that happens. Okay, stochastics RSI, as you can see, similar. We get back into these levels. Good sign that we're going to have another leg up. We get into the 93 section. Good sign that we have exhausted and we're going to be seeing at least some sideways action, which we did here before we got another boost up. But typically, it's a rollover. Okay. Then we got the 50-week moving average, which acts as a launch pad during bull markets, as it did here, as it did here, as we're about to see once again. Okay, so that's just maybe the video was a little bit longer than I was expecting. Maybe I'll go through and I'll cut a little bit out here and there to try to chop it down to make it a little bit more easier to digest, I guess. But yeah, I hope that makes things a little bit more clear. If there were some questions you had about these charts, like I mentioned, I want to go through and about make a video about the basket of indicators that we're going to be following. Maybe Minnow will want to do that one, and then make another video about specifically about the global M2, when to follow it, when not to follow it. All right, guys. I hope that helped. Chat soon.